Unless you are a mobile gamer, AppLovin may not be a name you've heard of, but today they are a $190 billion ad tech giant, larger than the biggest cybersecurity firm, Palo Alto Networks, in Latin America and e-commerce leader, Mercado Libre. AppLovin has been able to command such a valuation since their ad network can reach 1.4 billion active users per day. But the best part of their ads is they serve the high engagement mobile app space, which, due to their integration with the mobile games, will ensure more focused user attention. Think about the last ad experience you had. When viewing websites, our brain has trained itself to ignore out the ads. With YouTube videos, we can just look off the screen until the ad is over. AppLovin's mobile ads are either full screen ads that you have to click on to revert back to the game, or they are themselves gamified that can earn virtual currency for usage in the game. Either ad will get much more customer engagement, which is where brands will want to show themselves. Besides a better ad offering, where AppLovin has really set itself apart from competitors like Unity and The Trade Desk is its AI-powered advertising platform, Axon AI. An average campaign using Axon AI sees return on ad spend about 45% higher than that on Facebook and 74% higher than that on TikTok, Snapchat, and Pinterest. This is finally a useful application of AI. Unity's competitor, Audience Pinpointer, struggled to compete, and the Trade Desk's AI platform named Kokai has faced delay after delay. Hence, why AppLovin has taken more market share in this space and their stock has soared, while the Trade Desk's and Unity's has faltered these past 5 years. This shows in the numbers too. For revenue, looking at the past 5 years, and revenue has grown at a healthy CAGR of positive 36%. Because their platform is run fully by AI, they have incredible gross margins of around 80%. As you can see here, their gross profit also grew in sync with revenue at positive 36%. Incredible growth for both at 6x in the past 5 years. To keep up with this growth, AppLovin's focus is shifting from that on mobile game advertisement, which they've captured almost half of the $10 billion total addressable market, to focus on a much larger $800 billion e-commerce vertical and driving these brands to advertise their product. They've retrained their Axon AI model to predict gamers who will click on an e-commerce ad and then buy. If they can dominate this market segment that is 80 times larger than their current vertical, then AppLovin Stock should still have room to outperform. But let's look at a bull bear case for 2030 to evaluate if currently trading at a $190 billion market cap is fair value. For a 2030 scenario, let's first look at the bear case, and that is that AppLovin fails to execute and becomes viewed like the Trade Desk. The Trade Desk historically has been viewed as the ad tech leader, but their stock is currently 70% off its high and at a $20 billion market cap, 1/9 that of AppLovin. This is attributed to them experiencing a slowdown from 25+% year-over-year growth to only 18% this year. They have also failed in their rollout of their Kokai AI platform, which was to have become a major catalyst for the revenue acceleration this year and the years ahead. For AppLovin, let's assume their revenue growth decelerates from their average 5-year CAGR of 36% to only 25%. Using the Trade Desk's 8 price to sales ratio, this gives AppLovin a $152 billion market cap in 2030, much lower than the $190 billion market cap today. The key to AppLovin stock is the need to maintain their premium price to sales ratio. In this bull case scenario, AppLovin is able to execute and prove their Axon AI platform can excel in return on investment for the e-commerce brands wanting to advertise on mobile apps. Revenue thus does not decelerate and continues growing at this 36% CAGR. Price to sales maintains its premium based on this, and also the narrative that Axon AI's platform can now expand beyond e-commerce to other verticals like automotive or financial service brands. In this bull case scenario, the stock can nearly 4x from today's price. It's a pretty wide range between a bear case of minus 25% and a bull case of plus 400%. Now, Let's run it through our frameworks to determine which we believe is more likely. Before we do, please read the disclaimer in the notes below. We are not financial advisors, and anything we say should not be considered financial advice. Also, if you like content like this, please help us out and click a like and subscribe as we aim to analyze the most innovative companies twice per week. Now let's put AppLovin through my 5-point framework. For leadership, I give AppLovin a very strong. Their CEO is our co-founder and a decisive, product-centric, and aggressive strategist who prioritized building its Axon AI platform internally. Unity, at one point, was a strong competitor, but due to mishap after mishap from their now former CEO, they ceded significant market share of the mobile app advertising sector to AppLovin. Leadership truly matters. For valuation, I give AppLovin a week. I don't believe it reaches the full bear case scenario at minus 25% returns from here, but I do not believe it can compound 15% annually for the next 5 years for its stock price. They are heavily dependent on Apple, Google, and Facebook to allow for Axon AI's complex data collection methods. Unity went through a Apple privacy change, and it wrecked their algorithm, which pushed the stock much lower. Right now, everything seems priced to perfection for AppLovin. Their revenue growth is accelerating, and they have 80% gross margins, since their ad platform returns 45% better than ad spend on Facebook. For revenue and profit growth, this is a very strong. 80% gross margins are amazing, and revenue growth I expect to continue at greater than 30% annually for many years ahead. For total addressable market, I give this a strong. Both e-commerce and mobile advertising will be growing quickly and be over $1 trillion opportunity for each by 2030. The only reason it isn't a very strong is a risk that other competitors attempt to compete in mobile app advertisements with how large a total addressable market it will be. For secular tailwinds, this is a very strong. Digital and AI-enabled advertising will continue to grow double digits annually. The return on investment with the platforms are just too much better than alternates that brands will continue to put more of their budgets in this space. Overall, I love the business as my framework is strong or very strong for every metric but one, valuations. This means I don't like the stock at today's price. They are priced for perfection at 30 times sales that any slip up on their execution or a narrative headwind with Apple, Google's data privacy can cause a sell-off very fast. For me, the stock would need to be cut in half to about 250 for me to consider buying. What do you think, Dad, as you review AppLovin?
Scott, thank you for that excellent presentation. Okay, today I'd like to do my analysis for AppLovin, symbol APP. Okay, for the company fundamentals, the dividend is 0. The beta is 2.50, which means it's 150% more volatile than the S&P 500. Market cap is really high. It's 197 billion for a company, for this company, and then in my opinion it's high. But then for earnings comes out February 11th. So for this I'm a neutral to negative because of the beta, and the market cap I think is too high. Okay, the earnings history, it's beat 4 of the last 4 quarters, so that's good. For that I'm a positive. For financials, the profit margin is net profit margin is 50%. Debt to equity is over 300%, and the PEG ratio is 0.96, which the P is 72, and the earnings growth is 76. And I just don't know how this company could keep growing this fast at a market cap of 197. But anyway, that's what the earnings or the analysts think it's going to grow at 76% for the midterm, in the middle midterm. Okay, and then so for that I'm a neutral to positive. And then for stock technicals, the moving average slope is positive. The 50-day moving average is above the 200-day moving average. and the price is below the 50-day moving average, but above the 200-day moving average. The Bollinger Band is between the lower and middle band, but right now it's really hugging the lower band more so. And the volatility is neutral. It's kind of consistent with the last 6 months. And then the slow stochastic oscillator is at 12, which is in the oversold territory. So it's possible we have a short-term increase in the price, but nobody knows. But no analysis is that precise. But anyway, it is at 12, so that's oversold category. Because if it's below 20, it's considered oversold. MACD is neutral and unbalanced volume is neutral. So for that, it's a neutral to positive. And then for the analyst coverage, 1 sell, 5 holds, and 6 buys. And the price ranges 650 to 726 for the analysts, what they think the price could go to in the next year. And then the institutional percentage is 72. So for this, it's a neutral to positive. So anyway, this one was really hard for me to rate. It's very tough because the snapshot right now at this point it looks okay. Looks okay the price, but I can't see it at a market cap of $197 billion for a company that the analysts think are going to grow, and the analysts think it's going to grow 76% for the next 3 to 5 years. So I don't see it. But anyway, in the short term, I'm a maybe, Scott. In the long term, midterm and long term, I'm a no because of the debt and the beta is high. Although the beta can work both ways. It could go up and go down a lot. So some people like that. But anyway, for me, it's not worth the risk in the short term. But some people may want to try it because the slow stochastic oscillator is so low. That's the only reason that I would consider thinking about investing in this in the short term. And the PEG ratio is 0.96, as I say, but I just question how a company of this market cap can grow 76% for the next several years. So short term, maybe. Midterm, long term, no. So back to you, Scott.
Thanks, Dad. Understood that in the short term, the stochastic model points to some possible upside, but since long term we do not believe this is a good risk-reward buy at this valuation, we will not be adding. Great business, overvalued stock. With that said, thank you for watching. Please click a like and subscribe to keep up on our journey as we analyze most innovative companies twice per week. Until next time, happy investing.